G'day guys, welcome back to the SYD channel. My name is Carson and I'm your host. Well guys, today I have a massive video for you. I will be talking about 5 different shares and looking at the differences between them, especially when it comes to servicing their debt and potentially what the COVID-19 coronavirus outbreak will have on their revenues going forward into 2020 and 2021. So the 5 companies which I have done a relatively short analysis on, and by the way, this is all for entertainment purposes only. Please do not act on any of this information to make any financial decisions. This is just my opinion, and always do your own research. I implore for you to fully understand all the risks before you make any decisions. All right, let's get into the video. The stocks that I'll be talking about today. Number 1, Sydney Airport, ticker SYD. Number 2, Horizon Holdings, ticker AZJ. Number 3, Centre Group, ticker SCG. Number 4, Washington H. Soul Pattinson Co., ticker SOL. And company number 5 is WES Farmers, ticker WES. So, in amidst this coronavirus outbreak, this incredibly crazy crisis, what are people doing? How are investors reacting? And what should we do? Well, what I'm doing right now is having a cup of turmeric tea. Because as they say, a turmeric a day keeps the coronavirus away. Anyway, that aside, guys, in times of crisis, in times of falling stock markets and falling prices and a bottoming of the stock market nowhere in sight, I have a firm belief that the best strategy that we could possibly take as investors is to buy good quality assets. Good companies with good revenues and a low risk balance sheet. Now, what that means is that the balance sheet has a level of debt that is serviceable by the company's revenues and after-tax profits. So that's what this video is going to be about. We're going to look at all these 5 different companies, and I've got a different mix of companies. I have an airport company, a rail company, a shopping center group company, a diversified conglomerate, and another diversified conglomerate. So let's understand what these companies all do before we get into their financials. So first of all, Sydney Airport is pretty obvious what they do. They run Sydney Airport. Their revenues come from aeronautical services, retail, property and car rental, parking and ground transport. Horizon, they are a rail operator and owner. They transport coal and bulk commodities for various clients across the country. Centre Group is the shopping centre owner, and they own Westfield branded shopping centres across Australia. Soul Patts is a large diversified conglomerate, and they have different group entities. So they own very significant stakes in the following companies: TPG Telecom, Brickworks Limited, New Hope Corporation Limited, Milton Corporation, BKI Investments, API Pharmaceuticals, which is the owner of Priceline Pharmacies, and they have other investments, property investments, so they're a very diversified company. WES Farmers, again, very diversified. They own massive brands across Australia, such as Bunnings, Kmart, Target, Catch.com.au, Officeworks. They've got a 15% stake in Coles. They have massive industrials divisions. So just under the chemical, energy and fertilizer division, they own CSBP, which is a fertilizer company. They own some LNG manufacturers and transportation companies, Clean Heat. They are in the industrial and safety space, so they own Blackwoods, Workwear Group, and companies such as that. So these companies are very diversified. All right, so we've got an interesting mix of companies here. Now let's see which companies are going to survive and which companies may not survive. Now, I don't think that any of these companies are going to go bust, but I will give my opinion on which ones I think have the highest chance of going bust. Now, as we can see from this analysis, we can see in the first column the revenues from 2019, the net profit after tax from 2019 in the column over, and the profit margin of each company. Then I have made a couple of assumptions about the revenues that the company will experience in 2020 and the profit that they will receive in 2020. And I'm not going to get into the assumptions behind it, but let's just assume that this is the case. The next column is called the interest-bearing debts. So this is the total sum of debts that the company currently has, and it could be a mix of direct bank loans and bonds to the market and that sort of stuff. So basically, when these debts are due, the company must pay the debts off fully in cash. So the next column tells us what debts are due in, this year, 2020, and the column after that tells us what debts are due the following year in 2021. Right? So already we can see a couple of things here. We can see, and by the way, all these numbers, all these figures in here are in millions of dollars. So we can already see that by far, the company that is in the best financial, most secure position is Washington H. Pat, because they have $3 million due in 2020 and $5 million due in 2021. My expectation for their profits this year, 2020, is $200 million. $200 million. They can easily cover all their debts. Now, moving up the list, a company such as Horizon Holdings. They have $82 million in 2020 they need to pay off, and I'm anticipating for them to make $200 million profit this year. That's down from $473 million profit from the year prior. This is a huge drop. Whether this happens or not, it's pure speculation, but these are, again, conservative numbers, so it could happen. So, given that, even if their revenues drop by 50%, which is what I've assumed in this spreadsheet, even if their revenues drop by 50%, they still should make about $200 million profit. They can service that $82 million loan this year. Next year, they might be in a bit of trouble. They have $470 million to pay off. Now, the company that is in serious trouble is Center Group. They have $2 billion to pay off this year in 2020. And their revenue, I've assumed their revenue will get cut by 60%, which is pretty crazy. Probably not going to happen, but let's assume it gets cut by 60%. They're only going to make about $100 million profit in 2020. That's a deficit of $1.9 billion to pay off their debts. Sydney Airport is going to be in a lot of trouble in 2020 and 2021 financially. WES Farmers is going to be okay. So the two companies, surprise, surprise, that are going to probably ride this out the easiest are Washington and WES Farmers, because they are diversified and they have multiple streams of income. The third company on the list after that is Horizon Holdings. Now, let's take a look at how the stock prices have been affected over the last 6 months. Well, if we start off with the strongest company on the list, Washington, we can clearly see that the 6-month chart shows us that that the market has fallen more than Washington has, and that's because the investors in Soul Patts, they have full confidence that the company will survive. Let's look at Wesfarmers. Again, Wesfarmers is above the overall market drop over the last 6 months. Again, investors know intuitively, and they've done their research, and they know that that Wesfarmers is a strong company. However, if we go on to the third company on our list, which is Horizon, we can clearly see all of a sudden that Horizon has fallen more than the market has fallen over the last 6 months. That's because there are a few debt concerns there, a couple of debt concerns. Okay, next company, Sydney Airport Holdings. Sydney Airport Holdings, as we can see by the charts, they have fallen quite a bit more than the market as well. Obviously, the airport sector is getting hit the hardest. International flights cancelled, domestic flights slashed by well above 50%. But having said that, it is a great asset. Sydney Airport is not going anywhere. If Sydney Airport goes bankrupt, they're not going to turn it into an amusement park. They're not going to turn it into residential buildings. Sydney Airport will always be Sydney Airport. There will always be planes flying in and out of Sydney Airport. It is a very critical asset to the nation. So that company will not go bankrupt. It will not disappear. What will happen is the government may need to loan it some money so that Sydney Airport can pay off its loans this year and next year if they get into that much strife. So now let's take a look at the riskiest one in the group, which is Scentre Group. So how has the market reacted to Scentre Group? Wow, that is a whopping drop compared to the overall market. And if we look at it purely from a financial risk perspective, we now can understand why this is the case. The case is that the market is looking at what Scentre Group owes its debtors, and its debtors are expecting to be paid $2 billion from Scentre Group this year. And where is Scentre Group going to get that money from? Well, usually what these companies do is they get the money from another debtor, and they promise to pay that debtor back in 8 to 12 years. They take that money and they pay the existing debtors. So they're just rolling the debts down the road. That's how they deal with these debts. Can they do it in this environment? I don't know. We will have to wait and see. So guys, in this time that we're investing in, really have a think about what your strategy is and what you're expecting to get from your investments. If you are worried about companies going bankrupt, if you want to see less volatility in your portfolio and pick up great assets, pick up a company like Soul Patts, Wesfarmers, or Horizon Holdings. If, however, you want to still pick up a great asset, because let's face it, Sydney Airport and Westfield shopping centres, they are amazing assets, amazing real estate in fantastic locations. If you still want to pick up great assets right now, go for those companies, but understand that you're taking on a lot more risk. The returns could be greater, but they could be lower. And the volatility that you'll experience if you buy those companies will be a lot greater. So you're going to have bigger moves in any given period of time if you hold Sydney Airport and Scentre Group together in a portfolio versus holding Soul Patts, Wesfarmers, and Horizon Holdings in a different portfolio. Personally, for myself, I would rather buy Horizon, Soul Patts, and Wesfarmers. And just to be, just for some clarity here, I currently own shares in Scentre Group, Soul Patts, and Wesfarmers. After this video and understanding the my companies a bit better and doing this research, I would lean on the side of putting a little bit more into Scentre Group, just to lower my average price, because I believe they'll exit this not unscathed, but they will survive. They're a big company. They've got a parent entity as well, and I will be putting more money into Soul Pats and WES Farmers as well. In terms of adding to my portfolio, I would consider adding Horizon. I don't own any rail network companies, so that'll be pretty cool to buy some of that. Sydney Airport, I'm going to wait and see what happens with Sydney Airport. So I hope this analysis has given you guys something to think about for your own portfolio. And if you haven't thought about what debts are due in the companies that you own, have a strong think about it, because it matters and it's going to matter. All right, guys, good luck out there. Stay safe and see you in the next video. Bye.